Most investors believe that the best place to understand what's happening in the economy is the stock market. They observe the behavior of large companies, follow the indices, and try to interpret market sentiment from these movements. But throughout my career, I've learned something very different. If you really want to understand where the economy is going, you don't start with the stock market. You start with the bond market. This market is much less glamorous. It doesn't receive the same media attention. It doesn't appear in the headlines daily in the same way as tech stocks or the most famous companies. But there's a reason why institutional investors, central banks, and large global funds pay so much attention to it. The bond market functions as an early warning system for the economy. While the stock market reacts to narratives, enthusiasm, and growth expectations, the bond market reacts to something much more rigid: financial mathematics. It reacts to inflation. It reacts to real economic growth. It reacts to debt sustainability. And when these variables begin to clash within the economic system, the bond market typically senses it much sooner than anywhere else. Now, when I look at the current behavior of this market, I see something that deserves attention. It's not just normal volatility. It's not just a momentary reaction to monetary policy decisions. What we are observing is something deeper. Long-term bonds are beginning to reflect a growing concern among institutional investors, a concern related to fiscal sustainability, debt growth, and the balance of the global financial system. These signs don't appear dramatically at first. They begin subtly, almost silently. But throughout financial history, whenever the bond market starts to issue this type of warning, there is good reason to pay attention, because many of the great financial crises of the past began exactly like this. First, small anomalies in bond behavior emerge. Then distortions in the yield curve appear. And only later do the rest of the markets realize that something truly important is happening. Today we are again at a point where these signs are emerging. The question we need to ask is not just whether the market is reacting to momentary events. The real question is different. Is the bond market beginning to anticipate a much larger debt crisis than most people imagine? In the next few minutes, I want to show exactly what these signs are, why they are appearing now, and why experienced investors are beginning to observe this market with much more attention. But to fully understand this, we first need to grasp something fundamental. We need to understand why the bond market often spots problems long before the rest of the financial system. And that's exactly what we're going to analyze next. To understand why the bond market often detects problems before the rest of the financial system, we need to understand a structural difference between two major markets: stocks and bonds. The stock market is highly sensitive to narratives. It reacts to expectations of growth, innovation, technology, and investor enthusiasm. Often, movements in the stock market reflect the collective mood of the participants. The bond market works very differently. When an investor buys a bond, they are not just buying an idea about the future. They are buying a financial contract with extremely clear rules: periodic interest payments and repayment of principal on a specific date. This forces the investor to make much more rigorous calculations. They need to accurately estimate what inflation will be in the coming years, what economic growth will be, what the central bank's interest rate policy will be, and, most importantly, what is the probability that the issuer will be able to repay its debt in the future. This analysis involves direct financial mathematics, discounted cash flow, and macroeconomic risk assessment. That's precisely why the bond market often reacts early. If investors begin to believe that inflation may remain high, bond yields adjust rapidly. If investors perceive that fiscal deficits are growing rapidly, this also quickly appears in the rates demanded by the market. And if any doubt arises about the long-term sustainability of debt, the bond market tends to reflect this concern long before other assets. This behavior is not theoretical. It appears repeatedly in economic history. Before several modern recessions, the yield curve shifted significantly. Before the global financial crisis, the credit market began to show signs of stress long before the headlines. Before several sovereign debt crises around the world, the first place where the problem became evident was precisely in the bond market. There is a structural reason for this. Large bond buyers, such as pension funds, central banks, and sovereign wealth funds, manage an enormous amount of capital. They need to make decisions based on long-term risk, not just short-term movements. This means that when these institutions begin to adjust their positions, movements in the bond market often reflect profound changes in perception of global risk. Now, when we look at the current environment, we see that several of these institutional participants are beginning to behave more cautiously. Yields in different parts of the yield curve are adjusting. Risk premiums are beginning to shift, and the market is beginning to incorporate the possibility of a more unstable economic scenario in the coming years. These movements don't necessarily mean that a crisis is inevitable, but they indicate that the market is beginning to reassess something very important: the sustainability of the current level of debt in the global economic system. And that's exactly what we need to talk about now. Because to understand why the bond market is reacting this way, we need to look at one of the most important factors in the modern economy: the extraordinary growth of global debt in recent decades. Now, we need to look at the factor behind virtually all the tensions that are beginning to appear in the bond market: the growth of global debt. In recent decades, the global economic system has undergone a profound transformation. Whenever an economic slowdown or financial crisis arose, the response adopted by economic authorities was essentially the same: stimulate the economy through cheaper credit and fiscal expansion. This means lower interest rates and more public spending. For a short period, this strategy usually works. Low interest rates encourage companies to invest, consumers to spend, and governments to finance economic programs. The problem is that this process also encourages something that grows silently over time: the accumulation of debt. After the 2008 global financial crisis, the world's major central banks reduced interest rates to extremely low levels. In some cases, rates remained close to zero for many years. At other times, they even reached negative levels. This environment of cheap credit completely changed the behavior of the financial system. Companies began to finance their operations with debt more easily. Governments increased their deficits without facing very high immediate costs. Consumers had access to more abundant credit. During this period, it seemed that the system could sustain ever-increasing levels of indebtedness. But there's a simple economic principle that never disappears: debt needs to be financed. While interest rates remain very low, the cost of carrying this debt may seem manageable. However, when the interest rate environment begins to change, the mathematics of the system changes along with it. That's exactly what we're starting to see now. In recent years, inflationary pressures have forced central banks to raise interest rates. This movement has profound consequences for a system that has long been accustomed to operating with extremely cheap credit. When interest rates rise, the cost of financing debt also rises. This affects governments that need to roll over large volumes of bonds. It affects highly leveraged companies, and it affects consumers who depend on credit to maintain their spending levels. In other words, rising interest rates begin to expose weaknesses that were hidden during the period of cheap money. And when institutional investors begin to perceive these weaknesses, they adjust their expectations. This adjustment appears directly in the bond market. Higher rates, higher risk premiums, and changes in demand for sovereign debt gradually begin to emerge. Initially, these movements may seem like mere technical adjustments, but throughout financial history, they have often represented something bigger: the beginning of a process in which the market starts to question the sustainability of very high levels of debt. And when this questioning begins to gain momentum, the financial system enters a much more delicate phase, because confidence in the continued financing of debt is one of the central pillars of modern economic stability. And when this confidence begins to be reassessed, the bond market is often the first place where this change becomes visible. That is precisely why we need to look closely at another extremely important signal that is emerging right now: the behavior of long-term bonds. Now, let's look at one of the most important indicators within the bond market: long-term bonds. These bonds are extremely relevant because they reflect expectations about the future of the economy over much longer horizons. When investors buy bonds with long maturities, they are not just assessing the current state of the economy. They are trying to predict what might happen in the next 10, 20, or even 30 years. This means that the behavior of these bonds contains a huge amount of information about market expectations. If investors believe that inflation will remain under control and that the economy will grow steadily, they typically accept relatively low yields to hold these bonds. But when doubts about the future arise, especially doubts related to inflation, fiscal policy, or economic stability. The reaction is usually immediate. Investors are starting to demand higher interest rates to buy these bonds. This increase in yields acts as a kind of compensation. The higher the perceived risk, the higher the return needs to be to attract buyers. This mechanism may seem simple, but it carries profound implications for the financial system. When long-term yields begin to rise consistently, it may indicate that institutional investors are becoming more cautious about the economic future. They may be concerned about persistent inflation. They may be observing high fiscal deficits. Or they may simply be assessing that the amount of debt that will need to be issued in the coming years will be much greater than the market was previously expecting. In any of these cases, the result is the same. Long-term yields rise. And when that happens, the impact spreads rapidly throughout the economy. Financing rates for governments may increase. Credit costs for businesses may rise. Mortgages and long-term loans may become more expensive for consumers. In other words, movements in the long-term bond market end up influencing virtually every sector of the financial system. This is why institutional investors follow these indicators so closely. When these bonds begin to show structural changes in behavior, it may mean that the market is anticipating important transformations in the economy. And it is precisely at this point that another critical mechanism within the financial system emerges. One mechanism that can significantly amplify these movements is what we can call the debt upswing cycle, in which higher interest rates begin to fuel even more debt issuance, creating a process that can become increasingly difficult to control. Now, we need to understand a fundamental mechanism that begins to operate when a highly indebted system faces higher interest rates. This mechanism is simple in appearance, but extremely powerful in its consequences. I usually describe it as the debt upswing cycle. It works as follows. When interest rates rise, the first immediate effect is an increase in the cost of existing debt. Governments that need to refinance old bonds end up paying higher interest rates on new issuances. Highly leveraged companies also face higher costs to renew their financing. The same happens with consumers who depend on credit. In the case of governments, this effect can be particularly significant. Governments frequently operate with fiscal deficits, meaning they need to issue new bonds regularly to finance their spending. When interest rates are low, this process may seem manageable. But when interest rates start to rise, the annual cost of holding the debt increases rapidly. This creates a chain reaction. If the cost of debt rises, the fiscal deficit tends to increase. And when the deficit increases, the government needs to issue even more bonds to finance its operations. More bond issuance means a greater supply of debt in the market. And when the supply of bonds increases, investors may demand higher yields to absorb this additional volume. At this point, the cycle begins to reinforce itself. Higher interest rates increase the cost of debt. The increased cost of debt widens the deficit. Larger deficits require more bond issuance. More bond issuance puts pressure on interest rates again. This is a cycle. For many years, this process was smoothed by extremely accommodative monetary policies. Central banks kept interest rates low and, in some cases, bought large amounts of bonds through stimulus programs. These interventions helped keep financing costs under control. But the current economic environment is different. When inflation becomes a significant concern, central banks have less room to maintain extremely expansionary policies. This means that the market needs to absorb a larger share of the debt issued by governments. And when the market starts absorbing ever-increasing volumes of bonds, sensitivity to interest rates increases. Investors become more selective. They carefully analyze fiscal risk, the pace of economic growth, and the government's ability to manage its long-term financial commitments. It is precisely in this environment that the bond market begins to emit important signals. Signals that the balance between debt, economic growth, and interest rates may be entering a more delicate phase. But there is another crucial factor also influencing this process. For decades, a significant portion of the debt issued by major economies was purchased by foreign investors and international central banks. Now, the behavior of these buyers is beginning to change. And this change had profound implications for the functioning of the bond market in the coming years. Now we need to look at a factor that often goes unnoticed by the general public, but which has an enormous influence on how the bond market works. Who is buying this debt? For decades, the international financial system operated with a relatively stable flow of buyers of U.S. government bonds. Among the largest participants were foreign central banks, sovereign wealth funds, and large global financial institutions. These buyers had several reasons for holding large amounts of bonds in their reserves. First, U.S. government bonds have always been considered one of the safest assets in the world. They offer liquidity, predictability, and a stable legal structure. Secondly, many countries use these bonds as a way to manage their international reserves, especially those that accumulated large trade surpluses. This arrangement helped create an important balance in the global financial system. Governments could issue large amounts of debt, and at the same time there was a solid base of buyers willing to absorb these bonds. But over the past few years, some signs indicate that this dynamic is beginning to gradually change. Some countries are diversifying their reserves into other types of assets. Others are reducing the pace of foreign bond purchases to strengthen their own domestic financial systems. These changes do not happen abruptly. They usually occur slowly, over several years. But even gradual changes can have a significant impact when we're talking about a market that moves trillions of dollars. If large buyers begin to reduce their participation, the market needs to find new investors to absorb the growing volume of debt issued. And to attract new buyers, it's usually necessary to offer something extra. Most of the time, that something extra means higher interest rates. This is one of the reasons why long-term bond yields can start to rise even in environments where economic growth doesn't seem particularly strong. The market is adjusting prices to balance supply and demand. When the supply of debt grows rapidly and structural demand begins to adjust, bond prices can fall, and that means higher yields. This process may seem technical at first glance, but its consequences are far-reaching. Higher yields in the bond market influence virtually every other interest rate in the economy. They affect corporate finance, mortgage lending, investments, and even the behavior of stock markets. In other words, changes in global demand for bonds are not confined to a single market. They end up influencing the entire financial system. And when we combine this change in demand with the accelerated growth of debt and higher interest rates, an environment emerges in which investors begin to observe another extremely important indicator much more closely. This indicator is the yield curve, one of the most traditional signals that the bond market uses to anticipate economic slowdowns. Now we come to one of the indicators most closely watched by economists, central banks, and institutional investors, the yield curve. At first glance, this concept may seem technical, but in practice it is quite simple. The yield curve represents the relationship between the interest rates of bonds with different maturity dates. Normally, long-term bonds pay higher interest rates than short-term bonds. This is because the longer the time to maturity, the greater the uncertainty. Investors demand higher compensation to take on this additional risk. Under normal economic conditions, therefore, the yield curve has a positive slope. Interest rates gradually increase as the bond's maturity extends. But sometimes something unusual happens. At certain points in the economic cycle, short-term interest rates rise above long-term interest rates. When this occurs, we say that the yield curve is inverted. This inversion is important because it reflects a profound shift in market expectations. When investors accept lower interest rates in the long term than in the short term, it generally means they believe the economy will slow down in the future. In other words, the market begins to anticipate that interest rates may fall again in the future, possibly in response to a recession or a significant economic slowdown. Historically, this signal has been extremely relevant. Before virtually every modern recession in the United States, the yield curve has gone through periods of inversion. This doesn't mean that every inversion immediately leads to a crisis. The time between the signal and the economic slowdown can vary. Sometimes this interval lasts several months. But the history of this indicator is impressive. It has repeatedly served as one of the most consistent warning signs within the financial system. Now, when we look at the current environment, we see something that has caught the attention of many analysts. The yield curve has undergone a significant and persistent inversion. This type of behavior typically appears when the market believes that current economic conditions are not sustainable in the long term. Investors may be assessing that current interest rates are putting pressure on economic growth. Or They may be anticipating that the economy will have difficulty sustaining high levels of debt in a more expensive credit environment. Regardless of the specific interpretation, the main point remains the same. The bond market is sending a cautionary signal. This signal should not be interpreted as an exact prediction of what will happen, but rather as an important warning about growing risks in the economic system. And when we combine this warning from a yield curve with other factors we have discussed, such as debt growth and changes in global demand for bonds, we begin to form a broader picture, a picture in which the financial system may be entering a period of transition. The next question, then, is inevitable. What might happen if the bond market is indeed correct in its assessment of the economic scenario? Now we need to consider an extremely important issue. What happens if the bond market is correct in its reading of the economic scenario? Throughout financial history, whenever the bond market has begun to emit consistent signals of concern, such as structural increases in yields, changes in the demand for debt, and inversions in the yield curve, financial markets have entered periods of greater instability. This doesn't happen immediately. There is usually a lag between the emergence of these signals and the broader effects on the economy. But when the adjustment finally begins, it can spread rapidly across various sectors. The first effect usually appears in the volatility of financial markets. When investors begin to question prevailing economic expectations, asset prices can move more intensely. Swings that previously seemed improbable begin to occur more frequently. This happens because the market begins to reassess risks that were long considered low. Another possible effect involves assets that are heavily dependent on low interest rates. For more than a decade, much of the financial system has become accustomed to operating in an environment of extremely cheap credit. Companies were able to finance expansion at reduced costs. Investors sought returns in riskier assets, and governments increased spending without facing immediate financing pressures. When the interest rate environment changes, this equilibrium also shifts. Highly indebted companies may face higher financing costs. Sectors that rely on cheap credit may slow down, and investors may begin to reassess the risk-return relationship across different asset classes. There is also a third effect that deserves attention. When the bond market begins to demand higher yields to finance public debt, this can put pressure on economic policy. Governments then face higher costs to maintain their fiscal deficits. This may require budget adjustments, changes in economic policies, or other decisions that directly influence economic growth. In other words, the bond market not only reacts to the economy, it can also influence the course of economic policies. This is a crucial point for understanding how the modern financial system works. Changes in interest rates don't just affect institutional investors or banks. They affect the entire financing structure of the economy. And when these changes occur in an environment already marked by high levels of debt, the effects can be even more widespread. But in moments like this, there is a clear difference between two types of investors. On one side are those who react only when crises have already become evident. On the other side are those who carefully observe early warning signs and adjust their strategies in advance. It is precisely this mindset that we need to talk about now. Because in times of macroeconomic uncertainty, how investors think about risk can make all the difference. When the economic environment begins to show signs of change, the mindset of even the most experienced investors changes. During periods of stable growth and abundant liquidity, most market participants focus their attention on one main question: how to maximize returns. But when signs of instability emerge, especially those coming from the bond market, the question begins to shift. Institutional investors start asking themselves something different: how to protect capital in a more uncertain environment. This change in mindset may seem subtle, but it profoundly alters how financial decisions are made. Instead of solely seeking aggressive growth opportunities, investors are now paying much closer attention to three fundamental factors. The first factor is leverage. During periods of cheap credit, many companies and investors use debt to amplify returns. While economic growth remains strong and interest rates are low, this strategy can work relatively well. But when interest rates start to rise or when growth slows, high levels of leverage can become a significant risk. This is why experienced investors always carefully monitor the degree of debt present in their portfolios and the companies in which they invest. The second factor is liquidity. Liquidity represents the ability to quickly convert assets into cash without causing significant losses in value. During periods of financial stability, many assets appear highly liquid, but during times of market stress, liquidity can disappear rapidly. This means that investors begin to value more assets that can be easily converted into cash. The third factor is economic resilience. Experienced investors tend to assess which sectors or companies have business models capable of weathering periods of economic slowdown with greater stability. Companies with strong balance sheets, consistent cash flow, and less reliance on external financing are often seen as more resilient in challenging environments. This approach doesn't necessarily mean investors are anticipating an immediate crisis. It simply means they recognize that the macroeconomic environment may be entering a more complex phase. And when the financial system enters transitional phases, discipline and risk management becomes extremely important. Market history shows that periods of financial adjustment often follow long cycles of credit expansion. When these adjustments begin, they can rapidly alter investment conditions. That's why attentive investors carefully observe the signals we discussed so far: changes in behavior of long-term bonds, transformations in global debt demand, and signals coming from the yield curve. All these elements help build a broader picture of what might be happening within the global financial system. And this leads us to the final reflection. Because when the bond market starts sending multiple signals at the same time, ignoring them can be an extremely costly mistake for any investor. Now that we've analyzed all these signals, it's important to take a step back and look at the complete picture. Throughout modern financial history, the bond market has played a very specific role within the economic system. It functions almost as a diagnostic mechanism for the global economy. While other markets may be influenced by enthusiasm, narratives, or short-term movements, the bond market tends to react much more directly to the structural conditions of the economy. It reacts to inflation. It reacts to economic growth. It reacts to fiscal policy. And most importantly, it reacts to debt sustainability. When all these factors are balanced, the bond market tends to behave relatively stably. Interest rates move gradually, and investors can assess long-term risk with more predictability. But when imbalances begin to emerge, when debt grows faster than the economy, when fiscal deficits increase, or when inflation expectations become more uncertain, the bond market is often the first to reflect this change. And today we are seeing several of these elements emerging simultaneously. We have historically high debt levels in many major economies. We have gradual changes in global demand for bonds. We have periods of yield curve inversion, something that has historically preceded several economic slowdowns. None of these signs in isolation guarantees that a crisis is about to happen. But when several of these signs appear simultaneously, they deserve attention. Financial history shows that major economic adjustments rarely arise completely out of nowhere. Most of the time, the signs appear in advance, first discreetly, then increasingly clearly. And repeatedly, these signals appear in the bond market. That's precisely why institutional investors watch this market so carefully. They know that often, the most important messages about the future of the economy don't come from the day's headlines, but from the silent movements within this market. Perhaps the current scenario will evolve relatively stably. Perhaps the risks we discuss today will end up being managed by economic policies and global growth. But completely ignoring these signals would be unwise. Because when the bond market starts raising doubts about the sustainability of the financial system, it's worth paying attention. If you want to continue learning how to interpret these signals and understand how large investors analyze the market before major economic changes, subscribe to the channel now. In upcoming content, we will continue analyzing precisely these indicators that frequently reveal what is happening behind the headlines and that often anticipate the next major movements in the global economy.